Day trading replaces the decades-long horizon of a typical investment with a strategy designed to generate profit in a matter of minutes. A traditional investor buys a slice of a business because they believe in its long-term future. They evaluate the company's foundation and its leadership, holding those shares for years to watch them steadily appreciate. A day trader ignores the 5-year outlook entirely. They don't care if the company is successful next month or even tomorrow morning. They only care about how the stock price is moving in this exact moment. Success in this environment requires capturing present moment momentum, treating the stock market as a series of rapid price fluctuations rather than a collection of businesses. Imagine a traditional home buyer who researches the local schools and the neighborhood's growth potential. They buy a house intending to live there for 30 years as the property's value grows. A day trader is a high-speed contract flipper. They might buy a house at 10 in the morning without ever stepping inside or checking the foundation, with zero intention of ever moving in or making repairs. Their only goal is to hold the deed for a few hours. If market demand is high that morning, they plan to offload that same deed to another buyer by 2 in the afternoon for a quick profit. These traders act as fast-paced middlemen, capturing tiny price changes as demand shifts throughout a single day. Regular investing usually involves waiting for a significant gain, like a $50 stock doubling in value over several years to generate a substantial return. Day traders exploit micro-movements. They look for a $10 stock to briefly jump 10 cents. To make this worthwhile, traders use high volume. Buying 5,000 shares at once turns that tiny jump into a $500 profit in minutes. This reliance on volume is the only way to make the strategy viable, as the profit margin on any individual share is often too small to measure. This system requires volatility to survive. A stable, boring company with a flat stock price offers no opportunity. The trader thrives on the chaos of rapid price swings. They also need extreme liquidity. There must be a massive volume of buyers and sellers active at that exact second, ensuring that when the trader clicks sell, someone else takes the shares instantly. To find these conditions, traders ignore traditional news or earnings reports and focus exclusively on mathematical charts. They use technical indicators like moving averages and volume spikes on 1-minute or 5-minute timelines. These charts act as a real-time map of market psychology, showing exactly where a crowd of buyers is beginning to pile in or panic. On these screens, the company's product or reputation disappears, replaced by a visual pattern of human behavior that the trader must read and react to in seconds. The day trading timeline is rigid. It begins at the 9:30 a.m. market open and follows the momentum of the crowd until the 4 p.m. closing bell. When that bell rings, a true day trader holds 0 stocks. They have sold every share and converted their entire portfolio back into cash. Holding stocks overnight is an unpredictable risk. A company could release disastrous news at 8 in the evening, causing the stock to crash before the market even opens the next morning. Returning to a cash-only position every single day is the ultimate defensive move, ensuring the trader is never surprised by news breaking while they sleep. This speed makes the profession incredibly dangerous. If a trader buys a massive volume of shares and the price drops 20 cents instead of rising, they can lose hundreds of dollars in a single 5-minute window. To manage this, traders use an automated safety switch called a stop loss. If a stock bought at $15 drops to $14.90, their software automatically sells the position to prevent a total financial collapse. Even with these tools, the greatest threat is emotional discipline. Most failures occur when a trader allows personal greed or panic to override the data on their screen. Day trading remains a high-stress exercise in mathematical discipline, where survival depends on accurately predicting short-term human panic while remaining completely immune to it.